Hour by hour, the situation grows more complicated. First, Donald Trump was raising tariffs. Now the current US president is cutting them. Seeking to slow inflation, the White House plans to reduce import duties on food products from several Latin American countries. How should the US dollar react? If it has been falling since Independence Day, why wouldn't the USD Index rise now? Yet another puzzle for investors, who already have plenty to worry about on the Forex market as autumn draws to a close. The key question is, why is the US dollar weakening when the odds of a federal funds rate cut in December are falling? Normally, the opposite happens. Such derivative signals usually trigger selling in USD, but not this time. Why? It seems the market trusts its ears more than its eyes. Alternative data points to cooling employment and accelerating inflation, yet investors prefer to wait for official statistics. US inflation dynamics. The Federal Reserve's hawkish rhetoric leaves the door open for a possible reduction in borrowing costs at the end of 2025. Derivatives currently price the odds at 50-50, down from 72 just a week ago. Lower probabilities put pressure on stock indices. In theory, a decline in the S&P 500 should strengthen the US dollar. In practice, it hasn't. The greenback is behaving like a risk asset, falling alongside the US equity market. The USD Index is under pressure due to rumors that the Federal Reserve may soon resume its asset purchase program. Credit market rates have risen due to liquidity shortages, and the central bank isn't happy about it. A shift toward balance sheet expansion would be the bullish factor for USD. Fed rate dynamics vs credit market rates. According to an ING survey, 40% of investors believe the euro will trade in the 1.20–1.25 range for most of 2026. Another 36% expect 1.15–1.20. Only 2% foresee the common currency climbing above 1.25, while 4% predict a drop below 1.10. ING itself forecasts USD at 1.22, supported by fiscal stimulus and accelerating Eurozone GDP growth. Validus Risk Management argues that the US dollar is overvalued even after its 10% decline in the first half of the year. The firm believes Donald Trump will soon renew his pressure on the Fed to aggressively cut rates, eroding confidence in the greenback, fueled by the US president's attacks on the central bank, could strengthen the bullish case for USD. By contrast, Bank of America expects the USD Index to rise from current levels, noting that the dollar has become more sensitive to interest rates and that markets have overestimated the extent of the Fed's monetary expansion. From a technical standpoint, the daily US chart shows a return to fair value at 1.1625. An inside bar has formed, allowing for long positions on a breakout above 1.1650 and shorts on a move below 1.1605. The material has been provided by robotfx.org.